Thank you for joining us. I'm Gord Long with the Financial Repression Authority. It's my pleasure to have with me today Dr. Michael Hudson. Professor Hudson is very well known in terms of the FIRE economy, I think, to a lot of our listeners, or at least he's recognized by many as fostering that concept. But well-known author, has published many, many books. Welcome, Professor Hudson.
Yeah.
Let's just jump into the subject. I mentioned the FIRE economy because I know that I have always heard it coming from yourself, or indirectly, not directly from yourself. Could you explain to our listeners what's meant by that terminology?
Well, it's more than just people getting fired. FIRE is an acronym for the finance, insurance, and real estate sector. And basically that sector is all about assets, not production and consumption. And most people think of the economy as being producers making goods and services, paying labor to produce them, and then labor is going to buy the goods and services. But this production and consumption economy is wrapped in the asset economy, finance, insurance, and real estate of who owns assets, who owns other things.
How would you differentiate it, or would you, with what's often referred to as financialization, or the financialization of our economy? Are they one and the same?
Pretty much. The finance, insurance, and real estate sector is dominated by finance. For instance, 70 to 80% of bank loans in North America and Europe are mortgage loans against real estate. So instead of a landlord class owning property free and clear, as they did in the 19th century. Now that you've had a democratization of real estate, and 2/3 or more of the population owns their own home, the only way of buying a home or commercial real estate is on credit, so that the loan-to-value ratio goes up steadily. Banks lend more and more money to the real estate sector, and a home or a piece of real estate or a stock and bond is worth whatever banks are going to lend against it. And as banks loosen their credit terms, as they lower the interest rates, take lower down payments, and basically lower amortization rates, interest-only loans, they're going to lend more and more against property, and so properties bid up on price, but all of this rise in price is debt leverage. So a financialized economy is a debt-leveraged economy, whether it's real estate, or insurance, or buying an education, or just living. And debt leveraging means not only a larger proportion of assets are represented by debt, so the debt-equity ratios rise, but also financialization means more and more of people's income and corporate income and government tax revenue is all paid to creditors, and so there's a flow of revenue from the production and consumption economy into the financial sector.
I don't know if you know Richard Duncan, who was with the IMF, et cetera, and lives in Thailand. He argues right now that capitalism is no longer functioning, and really what he refers to we have now is creditism. Because in capitalism, we have savings that are reinvested into productive assets that, in fact, create productivity, which leads to a higher standard of living. We're not doing that. We have no savings, and investments are so highly in the financial sector today, they're not being reapplied into productive assets. Is he valid in that thinking?
No, and neither is your statement. It's completely invalid.
Okay.
We have an enormous amount of savings, gross savings. But people who are, the savings that we have that are mounting up, they're just about as large as ever at about 18 or 19% of the U.S. economy. Mm-hmm. They have their counterpart in debt. So the savings are lent out to borrowers at debt. So you have savers at the top of the pyramid, the 1%, lending out their savings to the 99%. Now, the overall net savings rate may be zero, and that's what your stupid person from the IMF meant. But the gross savings are higher. Now, the person, Mr. Duncan, obviously, I don't know what to say when I hear this nonsense. Every economy is a credit economy. Let's start in ancient Mesopotamia. We've done the group that I had out of Harvard has done a long study of the origins of economic structuring in the Bronze Age even the Neolithic. In the Bronze Age economy, 3200 BC to about 1200 BC. Suppose you're a Babylonian in the time of Hammurabi, about 1750 BC, and you're a cultivator. How do you buy things during the year? Well, if you go to the bar to an ale woman, what she'd do is she'd write down the debt that you owed, and that was to be paid on the threshing floor. The debts were paid basically once a year when the income was in, on the threshing floor. If the palace or the temples would advance animals or inputs or other public services, this would be a debt. It was all paid. The IMF has this Austrian theory that pretends that money began as barter and that capitalism operates in barter. And this is a disinformation campaign. It's nobody believed this in times past. And this is a very modern theory that basically is used to say, oh, debt is bad. And what they really mean is public debt is bad. The government shouldn't create money. The government shouldn't create deficits. You should leave it all to the banks. And the banks should somehow run up debt and indebt the economy. We're dealing with a whole kind of public relations mythology that's used as a means of deception for most people. You can usually ignore just about anything the IMF says because these are lobbyists. And if you understand money, you're not going to be hired by the IMF. The precondition for being hired by the IMF is not to understand finance. If you understand finance, you're immediately fired and blacklisted. That's why they impose austerity programs that they call stabilization programs that actually are destabilization programs, almost wherever they're imposed.
Is this a lack of understanding, an adherence to a wrong philosophy, or how do we get into this trap?
When you have an erroneous view, a lack of understanding, this is not by accident. When you have an error repeated year after year after year, decade after decade after decade, it's not really insanity doing the same thing thinking it'll be different. It's sanity. It's doing the same thing knowing the result will be the same again and again and again. The result will indeed be austerity programs make the budget deficit even worse, drive governments further into debt, further into reliance on the IMF, so that then the IMF turns them into the knuckle breakers, the World Bank, and they say, oh, now you have to pay your debts by privatization. It's the successful error of monetarism is to force countries to have such self-defeating policies that they end up having to privatize their natural resources, their public domain, their public enterprises, their communications and transportation, like you're seeing in Greece, and sell it off. So when you find an error that is repeated, it's deliberate, it's not insane, it's part of the program, not a bug.
Where does this lead us? What's the roadmap ahead of us here?
In 1,000 years ago, if you were a marauding gang and you wanted to take over a country's land and its natural resources and its public sector, you'd have to invade it with military. But now you use finance to take over countries. So it leads us into a realm where everything that the classical economists argued for, public investment, bringing costs in line with the actual cost of production, that's all rejected in favor of a rentier class evolving into an oligarchy. Basically, financiers in the 1% are going to pry away the public domain from the government. They're going to pry away and privatize the public enterprises, land, natural resources, so that they get all of the revenue, basically rental revenue more than profits from these enterprises for themselves, and it's all sucked up to the top of the pyramid, impoverishing the 99%.
Well, I think most people without understanding economics, would instinctively tell you they think that's what's happening right now in some way.
Right. As long as you can avoid studying economics, you know what's happened. Once you take an economic course, you've stepped into the brainwashing an Orwellian world.
I think you said it perfectly well there. Exactly. It gets you locked into the wrong way of thinking as opposed to just basic common sense. Your book, the killing the host. What was the essence of the message there? Was it describing exactly what we're talking about here?
It's that finance has taken over the industrial economy, so that instead of finance becoming what it was expected to be in the 19th century, instead of the banks evolving from these sort of usurious organizations that lent to governments mainly to wage war, finance is going to be industrialized. And they were going to mobilize savings and plow it back in to financing the means of production, starting with heavy industry. This was actually happening in Germany in the late 19th century, where you had the banks working with government and with industry in a kind of triangular process. But that's not what's happening now. After World War I, and especially after World War II, finance has reverted to its pre-industrial form, and instead of allying themselves with industry, as banks are expected to do, banks have allied themselves with real estate and monopolies, realizing that they can make more money off real estate monopolies. And so while you had David Ricardo arguing against the landed interest in 1817, against land rent, now the banks are all in favor of supporting land rent, knowing that basically today now the people can buy and sell property, renters for paying interest, and they're going to get all of the rent. So you've had the banks merge with real estate against industry, against the economy as a whole. And the result has been that they're part of the overhead process, not part of the production process.
There's a sense that there's a crisis lying ahead in the next year, 2 years, or 3 years. The Main Street economy is so disconnected from Wall Street economy. What's your views on that?
It's not disconnected at all. The Wall Street economy has taken over the economy and is draining it. Under, say, what economist students are taught in Say's law, the idea of Say's law is the economy is workers are supposed to use their incomes to buy what they produce. That's why Henry Ford paid them $5 a day so they could afford to buy the Ford automobiles
exactly.
He was promoting. But Wall Street has interjected itself into the economy, and instead of the circular flow between producers and consumers, you have more and more of this flow being diverted to pay interest and to pay insurance and to pay rents. In other words, to pay the fire sector that all ends up with the financial sector, most of which is owned by the 1%. So the way of formulating it, saying somehow it's in a bad cycle or it's secular stagnation, that removes the element of agency. The agency is active politicking by the financial interests and the lobbyists on Wall Street to obtain all of the growth of income and wealth for themselves. And that's what happened in America and Canada since the late 1970s.
What does an investor do today, or somebody who's looking for retirement, trying to save for the future, and they see some of these things occurring? What should they be thinking about, or how should they be protecting themselves?
What all of the billionaires and the expensive the heavy investors do is they're simply trying to preserve their wealth. They're not trying to make money. They're not trying to speculate. And if you're an investor, you're not going to outsmart the billionaires, because the markets are basically fixed. It's the George Soros principle. If you have so much money, billions of dollars, you can break the Bank of England. You don't follow the market. You don't anticipate it. You actually make the market and push the market up, like the plunge protection team is doing with the stock market these days. You have to be able to control the prices, and you have the insiders making money, but the investors are not going to make money. And since you're in Canada, you can, I remember beginning in the 1960s, I used to look at the Treasury Bulletin and Federal Reserve Bulletin figures on foreign investment in the U.S. stock market. And we all used to laugh at Canada especially. The Canadians don't buy stocks until they're at the very top, and then they lose all the money. And finally, when the markets are all the way at the bottom, the Canadians decide to begin selling because they can see a trend, and then they miss the upswing. So it's just hilarious to look how Canada has performed in the flow of funds for the U.S. stock and bond market, and they did the same in the silver market. I remember when silver was going up to $50, the Canadians said, yes, we can see the trend now, and they began to buy it, and they all lost their shirts. So basically, if you're a Canadian investor, move.
Canadian investors are a better contrarian indicator than a Barron's front page cover, you're saying?
I think so. Once they get in, you know the bubble's over.
Okay. Absolutely on that one. What is your current writing? What is your current focus now
Well, I just finished the book, as you saw, Killing the Host.
Yes.
I'm working, my next book will be out in about 3 months. J is for junk economics. And it began as a dictionary of terms, just so I could provide people with the vocabulary. And, as we got in the argument at the beginning of the program, our argument was about the vocabulary we're using and the words you're using. Mm-hmm. And the vocabulary that is taught to students today in economics and is used by the mass media and by government spokesmen is basically a set of euphemisms. If you look at the television reports on the market, they say that any loss in the stock market is not a loss, it's profit taking. And they talk about money, the stock market rises. Oh, that's good news. Well, it's awful news for the short sellers, that it wipes out. Almost all the words we get are a kind of euphemism for to conceal the actual dynamics that's happening. For instance, secular stagnation means, it's all a cycle. Even the idea of business cycle. Nobody in the 19th century used the word business cycle. They spoke about crashes. They know that things go up slowly and then they plunge very quickly. That it was a crash. It's not the sine curve that you have in Joseph Schumpeter's business cycle. It's a ratchet effect, up, down, slow, up and down. A cycle is something that is automatic, and if it's a cycle, and you have leading and lagging indicators, as the National Bureau of Economic Research has, then you think, everything that goes up will come down, and everything that goes down will come up. Just wait your turn, and that means you should be passive. Well, that is the opposite of everything that was said in classical economics and the progressive era, when they realized that economies don't recover by themselves. You need the government to step in. You need something exogenous, as the economists say. You need something from outside the system to revive it. And the idea of this business cycle analysis is somehow you leave out the whole role of government. And if you look at neoliberal theory and Austrian theory, there's no role of government spending, no role of public investment. And the whole argument for privatization, for instance, is the opposite of what was taught in American business schools in the 19th century. The first professor of economics at the Wharton School of Business, which was the first business school, was Simon Patton. And he said public infrastructure is a fourth factor of production. But its role isn't to make a profit, isn't to be profitable, to add to it. It's to lower the cost of public services and basic inputs and basic needs, to lower the cost of living and lower the cost of doing business to make the economy more competitive. So that privatization of this adds in interest payments, dividends, managerial payments, stock buybacks, and mergers and acquisitions, and obviously builds all of these financialized charges into the price system and raises the cost of living and doing business.
Well, Michael, I thank you for the time. We're up against our hard line. I know we didn't have as much time as we always like, so we have to break. Any overall comments you'd like to leave with our listeners who might be interested in the School of Economics?
Well, just that the downturn that we're in, we're going into a debt deflation. And the key of understanding the economy is to look at debt. And if the economy has to spend more and more money, the reason the economy is not recovering isn't simply because this is a normal cycle. It's not because labor is paid too much. It's because people are diverting more and more of their income to paying their debts, and so they can't afford to buy goods. Markets are shrinking, and if markets are shrinking, real estate rents are shrinking, profits are shrinking, and companies, instead of using their earnings to reinvest and hire more labor to increase production, the companies are simply using their earnings for stock buybacks and dividend payouts to raise the share price so that the managers can take their revenue in the form of bonuses and stocks and live in the short run. They're all setting up to take the money and run, leaving the companies as bankrupt shells, which is pretty much what hedge funds do when they take over companies. So the financialization of the economy is the reverse of everything that Adam Smith, John Stuart Mill, and everyone you think of as a classical economist was saying, and they can wrap themselves in this cloak of classical economics by dropping the history of economic thought from the curriculum, which is pretty much what's happened. In Canada, I know since you're from Canada, my experience there was that the banks have a huge lobbying power over government. In 1979, I wrote for the IRPP Institute there on Canada's new monetary order, and at that time, Canada was, the provinces of Canada were borrowing money from Switzerland and Germany because they could borrow at much lower interest rates. And I said, look, this is going to be a guaranteed disaster, and it's completely unnecessary. If Canadian provinces borrow in francs or Swiss or any other foreign currency, this money goes into the central bank, and the central bank then creates Canadian dollars to spend. Well, the central bank can really create these dollars without having Swiss francs, without having German. It's completely unnecessary to have the intermediary. And the more thuggish banks you have, like Bank of Nova Scotia, said, oh, that way is the gas chambers, that way leads to the road to serfdom, and it's not. Following the banks and the Austrian school and the bank's philosophy, that's the road to serfdom. That's the road to debt serfdom, and that's the road that Canada do now, because it lets its universities and its government be run by the neoliberals, and they're a travesty of what real economics is all about.
Michael, thank you very much. Learned a lot. Appreciate it. Certainly appreciate how important it is for us to use the right words on the right subject when we're talking about economics. Absolutely agree with you. Talk to you again.
Good to be here.
Thank you for the time.